It's Matt Santagapita from the Santa Sells Houses team, and as a lot of you are aware, the Bank of Canada recently has done their fourth interest rate increase with the predictions of a fifth before the end of the year. So today we just wanted to discuss how that can affect you as a seller or a buyer. So why are interest rates going up? Well, in short, the Bank of Canada feels that the Canadian economy is robust enough and we're seeing enough GDP growth that they're confident in raising rates without causing any kind of stalling to our economy. So generally the Bank of Canada likes to see a growth rate of around 2.5%. We've been seeing that consistently over and over, and they are predicting that we're going to continue to see this type of GDP growth as well as strong employment growth. Therefore, rates are going up. And truthfully, let's be honest, it's been about a decade now that we have had ridiculously low interest rates, so it is about time. Let's take an assumption here that you're making a $400,000 purchase with 5% down. You tack on your, let's say, CMHC insurance premium. You blend that all together. You're looking at a borrowing dollar amount of $395,200 at a current 5-year fixed rate on a 25-year amortization. You'd be looking at a payment of around $1,973. Between 2019 and 2020, we're going to see roughly about 10 rate increases. For each 1% rate increase we see, as a buyer, your buying power is reduced by 6%. So as an example, on this type of scenario, you're looking at a reduction in purchasing power of $24,000. So over the next 2 years, if we take a, call it relatively conservative amount of, we're going to see a rate increase of about 2% total in the next 24 months, that's going to affect your ability to buy by the tune of $48,000. So in today's dollars, that $400,000 purchase is now moving to $352,000. CMHC is also predicting over the next 2 years that we will see inflationary pressure on housing prices. And what does that mean? Prices are going to continue to go up. Now that we've talked about how this affects a buyer, let's talk about how this affects a seller. Well, when we enter in a climate where we see inflationary pressure on interest rates and buying power is affected, in the example that I used earlier of the $400,000 purchase, if you're selling a $400,000 home and a person can qualify for $400,000 today, if we tack on a 2% rate increase over the next 24 months, that affordability rate drops by $48,000 and they can only afford $352,000. Now, they are saying that we are going to be seeing continued pricing increases for our area. However, that is just a crystal ball idea. We really don't know what is going to happen. Now that we've talked about how interest rate increases affect buyers, let's discuss how it's going to affect a seller. Well, in reality, when we see inflationary pressure on interest rates, it's going to drop people out of the bracket they're in today. So for instance, the example I gave, if today someone is shopping for a $400,000 home and that is all that they can qualify for, if miraculously we woke up tomorrow and interest rates jump by 2%, that affordability would drop down to $352,000, drastically affecting the net proceeds of a sale as a seller. So the reality that you have to look at, if we know we're seeing inflationary pressures on interest rates as a seller, you'll want to actually sell your home sooner rather than later because that buyer pool and their affordability is shrinking. So again, it's Matt Santagapita from the Santa Sells Houses team, and this has been a little bit about how our mortgage rate increases are going to affect you.